Many Texas homeowners find themselves in financial hardship after paying a high balance on their house. One solution is to obtain a payday loan, but with the high interest rate and high fees associated with these loans, these solutions may not be worth the paper they are written on. Many people choose to take out a loan because they are facing the possibility of losing their home in Texas. With a few exceptions, homeowners in Texas cannot avoid foreclosure due to a missed payment. If the new mortgage doesn't fall under the terms of the FHA or VA loan programs, the lender can foreclose. Many families have spent all of their savings in order to keep their homes from becoming foreclosures, and many of them have used what money they had in order to cover the cost of the first mortgage. The second mortgage still remains, the payment is now back on the borrower's credit and there is no way to avoid additional interest. Fortunately, there are options available for borrowers who find themselves in financial trouble due to Texas foreclosure. Several options exist to help the borrower get out of the predicament, but the one solution most preferred by most is to find a good lender who can work with the homeowner to obtain short-term funds that will allow the borrower to stay in his or her home for an extended period of time. A homeowner may have to repay the outstanding balance due on his or her loan before he or she can obtain a payday loan. It may be possible to be approved for another loan at a lower interest rate, but only if the first loan was repaid. In Texas, it is illegal for any lender to charge a higher interest rate for a loan if a borrower has had to pay off all of the balances due on the previous loan. Therefore, the homeowner must settle all existing balances on the mortgage before he or she can obtain a loan. A lender may offer consumers a lower rate on a short-term loan to pay off outstanding balances, but they will still charge the higher interest rate on a payday loan. Borrowers who borrow a minimum amount of money will not qualify for a low interest rate. They will have to pay a high amount of interest if they try to borrow more money than they have. A borrower in financial difficulty may consider applying for a few cash advance loans that would allow him or her to pay off the outstanding balance on the previous loan. This option is not a solution for those who are facing foreclosure. Another solution to help borrowers who are facing foreclosure is the use of high interest rates on payday loans to pay off the balance on the previous loan. These loans have higher interest rates than other payday loans because of the higher monthly payment required. The lenders tend to set their interest rate as high as possible to attract more customers, but they are in competition with each other to attract a certain share of the market. The borrower with the lower rate of interest is the one who will receive the loan the least amount of time. A solution to help borrowers in financial hardship is to look into the availability of high-interest loans such as payday loans. These loans can work out as a means of being able to pay off the previous balance before being able to receive a payday loan.